Have you gotten the sense lately that there's just a lot of risk in the market? Do you wish you had someone with a mountain of knowledge to just help you see it and know how to manage it? See, with so much volatility and systemic risks baked into the markets now, how do you even navigate this to dance around those risks and elevate your investing game? Well, I got good news for you. In this week's episode of Making Billions, I bring on my dear friend Kristof Gleich. Kristof is the president and chief investment officer of a $40 billion investment firm called Harbor Capital. Join Kristof and me as we discuss the current crises in the market and what you can do to prepare for it today. Managing risks, understanding economics, and allocating investments properly are all skills we need in our pursuit of making billions. Here we go. Hey, welcome to another episode of Making Billions. I'm your host, Ryan Miller, and today I have my dear friend, Kristof Gleich. Kristof is the president and chief investment officer at Harbor Capital Advisors, a $40 billion investment fund out of Chicago. So what this means is that Kristof has an expert-level view of markets, economics, and making billions from investing. So he's agreed to come on the show and provide an inside view of how he achieved the heights in the finance world and how you can navigate interesting economic conditions, much like the ones we've seen today. So Kristof, welcome to the show, man.
Ryan, it's great to see you. Thanks for having me. It's a big honor to be on your show. I'm a big fan and a big fan of the community that you've built. And yeah, it's great to be here.
Hey, we're honored to have you. Thank you. You're very kind. You know, to have someone with your background, it's truly an honor, but, and we can find that you're at Harbor Capital and we can read all about the cool stuff that you've done. And we're going to get into that in a moment. But before we do, we've got 100 countries around the world. All these people are wondering, what the heck, a chief investment officer and the president of Harbor Capital? How the heck did you even get there? So where did it start for you?
So I'll go back to the beginning. I'm in Chicago now. It's just got, it's the evening time here, so it's got dark. But my accent isn't a local Chicagoan accent, as your listeners or viewers may have told. So I'm from the UK, born and raised in the UK. That's where I grew up, and I've been living in the States now for about 8 years or so. And I guess for me, where it all began, it begins at school, right? In terms of people that shape you and mentor you, and you begin to learn a little bit about yourself. And I learned that I was pretty good at science, and I was quite interested in it, and I was okay at maths, or math as we call it here in the States. And that ended up taking me to university for an undergraduate degree, and I studied physics. I studied physics at Bristol University, which is in the west of England. I studied undergrad for 3 years, and I really, really enjoyed it. And going into it, I didn't know what I wanted to do. I wanted to just do something that I thought was interesting and I'd learn from, and it was no more complicated than that. And from that physics kind of foundation, I found my way into financial services. I joined Goldman Sachs in 2001. So where it all began professionally for me is I began actually working about 2 weeks before the 9/11 tragedy. So I really obviously, remember that time and, going into the markets. I was in London, but, you're shaped to a degree by kind of what happens in the earlier parts of your career. So I spent a while at Goldman Sachs. I spent some time at JP Morgan as well. But for me, like, my physics background is a big part of who I am today. I think it was a really important skill set that I learned in that physics. You have to be kind of observant of the world around you. You have to be intellectually curious. You have to be comfortable with opposing theories, kind of living and coexisting at the same time. You have to be comfortable with approximations. You have to be comfortable with contradictions, and you have to be comfortable with lots of uncertainty, and you have to be comfortable with that all at the same time. And I think from outsiders looking into the field of physics, people sort of think of this as a very precise world and it's very buttoned up. But actually it's not. It's quite chaotic when you look at all the different characters and how it sort of worked. And little did I know it, but that was quite a useful beginning for a life on Wall Street, or the city, as we call it in London. And that began my journey.
Wow, that is phenomenal. So, and at JP Morgan, when you were there, was it the asset management? I mean, how did that look?
When I began, like, first at Goldman, I was in the finance division, and then I moved after about 2 or 3 years. I didn't like my first job at all. And in fact, I thought I'd made a terrible mistake, and I almost left the industry. But before I did, some things that lined up, and I ended up moving to at the asset management side of Goldman. And so from about 2003, I worked within GSAM, which stands for Goldman Sachs Asset Management. And I joined a group, I would say fortuitously, it was called a manager research group. And we were supposed to find managers from all over the world to use in client portfolios. And so I kind of fell into this, and I've been doing more or less that type of thing since. And so when I went to JP Morgan, I worked within JP Morgan Wealth Management, which is where you're looking after more kind of like individuals' wealth needs. But I began life there running the research team for UCITS funds, and UCITS are kind of like the offshore version of 40 Act. And so I was in London, I was running a research team, and I was responsible for finding investments for clients in our LATAM, EMEA, and Asian private bank. So that was great. I had a global role. I cut my teeth in leadership, and a lot of travel, and it was great, and I loved it. And then in 2015, they asked me to move to New York and take over as global head of the team. And so I then began running a research team of about 60 people all over the world, and with about $500 billion of assets under management, which is obviously, it was a big number then. It's still a big number now. Yes, but it was great. It was a place that I loved to work, and it was a great time.
Phenomenal. So running a $500 billion fund, no big deal. I'm just kidding. That is a very big deal. Good for you. So you cut your teeth. So you went to school, you did a little bit of science, a lot of science. Then you went into finance, and then you launched your career in those bulge bracket banks, started in asset management, and really cut your teeth there. And now you're really kicking butt, and you're doing some wonderful things in Harbor. So maybe you can walk us in. How did you go from JP Morgan into Harbor, and maybe share with us a little bit about what you're up to at Harbor, and kind of paint a picture for us on current state.
I'd been working for almost 20 years, and I guess I kind of view that as maybe approaching halfway of your career. And I never grew up wanting to be a banker, and yet I'd worked for almost 2 decades at kind of 2 of the largest, best, most notorious, like pick your adjective, insert your adjective there, banks. And I kind of felt like banks had extracted their pound of flesh from me, and I wanted to get out of the banking sector. Even though I'd worked within asset management and wealth management, there's certain sort of regulatory obligations, I guess, that come for working with banks and really large companies as well. And I'd learned, a great skill set. When you go through and you work at institutions like that, you really learn about yourself, and you hone certain, skills. And I wanted to take that to the next chapter of my career. So I thought about what I liked doing, and kind of what got me out of bed in the morning. And it was investing, and it was asset management. I'm drawn by the long-term nature of it. When I grew up, I thought, after I joined Goldman, I thought I wanted to be a trader, because that was kind of the alpha male thing to want in the early 2000s. But then someone explained to me really clearly, actually the guy that ran GSAM at the time, and he said, look, there's 2 types of people in life. There's hunters and there's farmers. And he said, like, which one are you? Which one do you want to be? And like, trading is like hunting, like you eat what you kill. Asset management is more akin to farming. It's about, nurturing, doing things for the long term, and thinking in like years or decades ahead. And it really struck a chord with me then. And, some people might say that's really cheesy, but actually that's kind of been my experience of it as well. So it's been an analogy that works. So I wanted to be in a longer term business. Asset management is that. And so I joined Harbor Capital. I'll tell you a quick bit about Harbour in case your listeners don't know who we are. We're an asset management firm in public markets. We're headquartered in Chicago. We have about 40 billion of assets under management. And what makes us a little bit different from if you like, a traditional long-only firm is we find specialized boutique money managers or entrepreneurs, different thinkers, and we partner with them and we bring them to the marketplace and we help raise capital for them. And we offer these best-in-class investors in an appropriate vehicle. Historically, that was mutual funds. We have collective investment trusts, which get used in retirement. We have a big retirement channel. But most recently, ETFs, and specifically active ETFs. That's where a lot of the innovation's happening in the industry. Taxable clients are kind of voted with their wallets that they prefer the ETF structure. And so that's sort of a new area that we've been investing in and been quite creative in the last 18 months or so. So it's a great spot where I get to work with managers and investors across the world in equities and fixed income and in commodities. And I love doing it.
Yeah, that's phenomenal. And, from my research, I've noticed that you guys appear, and I'd love for you to speak on this. So in the ETF space, it appears traditionally we understand them, just the retail understanding is just a passive thing, kind of buy it, throw it in your portfolio, wherever that lands. It's kind of a passive thing. Now, from what I've seen and talking to you offline and getting to know your firm a little bit, you guys are starting to make a little bit of a push to active ETFs. I wonder if you can maybe talk a little bit about that and why is that kind of the new frontier for you guys?
For sure. So I think you're absolutely right that historically ETFs have kind of been synonymous with passive investing, and that linkage is beginning to change. And so why is that happening? So back in December of 2019, there was actually a regulatory change by the SEC, a good regulatory change. And now, listen, I'm not going to diss regulators. So I think they have a very hard job and they generally do it very, very well. But so in 2019, they leveled the playing field for issuers of funds like Harbour that issuing an ETF or issuing a mutual fund became very similar processes. So prior to 2019, if you wanted to launch an active ETF, you had to get something called exemptive relief. Exemptive relief is kind of a little bit like root canal surgery, with the dentist. It's not something you particularly want to do. It can be painful. The outcomes can be uncertain. And so there wasn't much activity or innovation in the space. So the regulators essentially created a playbook. And so what you've seen and what we've seen since late 2019 is new issuers coming to the market quite quickly and quite rapidly. And now if you look in any area of asset management, the area that has the highest organic growth rates is actually active ETFs. Of the ETF market, they represent about 5% of the assets. So it's still a small part. But if you look at it on a flow basis, the asset class is growing, by about 30% a year, and they're taking the area's taking about 20% of total flows every year. So it's growing. There's lots of innovation, and look, I'm a believer in active management, and I don't mean that in I don't have this religious belief that all active management is amazing. Like it's like anything, and it's some terrible active management. There's some average active management and there's some really good active management. But I believe in the value that good active management can bring to clients appropriately positioned with other investments, whether that's lower cost index investments, liquid alternative investments for those that can use that. But that area of the market that we play in is finding those exceptional active managers and then bringing them, now in ETFs, because for taxable clients, the argument has been one that, ETFs are a superior mousetrap. They're cheaper for the end client, and the only guaranteed free alpha in investing is doing something tomorrow, what you do today, but doing it cheaper. And so if you can do that, the mutual fund versus an ETF, it's structural fee alpha, if we want to get kind of jargonistic about it. And then there's also tax considerations. So Generally, our industry has been set up historically to look at things on a pre-tax basis, but of course, clients really eat after-tax returns. And ETFs, due to some of the mechanisms and structures and the way they work, they're able to offer and deliver clients a better after-tax return. They tend to be more transparent as well. And I'm a believer, all else being equal, in life, more transparency is better than less transparency. And ETFs offer more transparency versus other vehicles. So there's a preference there. And then the last thing about ETFs is you can trade them more frequently intraday. I'm on the fence whether this is a bug or a feature. It's kind of 6 of one, half a dozen the other. I'm a big believer in being a long-term investor. And just because you can do something frequently doesn't necessarily mean that you should do something frequently. And actually, I think one of the benefits of private equity over public equity is you're locking investors up and you're kind of saving them from themselves for a 10-year period.
That's 100% my viewpoint as well, Kristof. So, what I've been able to observe, and a couple of my guests have also commented on this, is because we've had real estate investors, venture capital, and some people and hedge funds people. And as you increase liquidity of an asset, you also increase the potential volatility. That's the belief. You're the scientist, so you'd probably be able to check my logic on that. So access to a very liquid market like public equities versus, say, real estate or a venture capital fund, that's really hard to move in and out of those investments, much like a hedge fund. So that kind of helps, to your point, save them from themselves, is because it's inherently baked in that you can't just move in and out like the public markets. And so that could be good, it could be bad, or it could be just neutral.
Yeah, look, I think what it does is it's a mechanism. I don't think it was designed for this purpose, but maybe it's a benefit that kind of came out of that is that you stay invested for longer, and generally staying invested for longer is better than speculating in the short run. And there's been various studies done. There's a little bit of a misnomer, I think, about less volatility in the sense that these businesses that sit within private funds are still on planet Earth. They're still exposed to the same vagaries of the up and down business cycle, but they don't have, if you like, the manic, depressive, or optimistic views driven by Mr. or Mrs. Stock Market. So that I acknowledge that point for sure. But Morningstar have done some good studies on this, really good studies. There's a ton of good work that they've done. And they actually showed within public markets, the more volatile the asset class, the bigger the difference between the time-weighted return and the money-weighted return, which means, you could have a manager or an asset class that has a 20% vol or a 30% vol. In an asset class where you've got a 30% vol, the behavior of people to chase in or run away from that asset class is higher, and they generally do a bad job of it. And so actually, even if that more volatile asset class earns more over the long run, investors actually earn less because they're terrible at timing it. And that's one of the biggest things that we're sort of very passionate about here, is spending a lot of time on education with clients and with advisors and trying to orient people for that, longer term, navigation through markets.
Brilliantly said. And, as we round third base on this discussion, this is phenomenal. I'm wondering, if you had 2 or 3 tips, because you see a lot of data, you analyze and synthesize a lot of information. And, one of the things in asset management, especially in the public equities, you learn this in undergrad, or maybe everybody on YouTube is preaching kind of the same Kool-Aid of this 60-40 asset split of constructing your own portfolio. I'm wondering if maybe you can share some opinion. Does the 60-40 classic asset allocation split of your personal portfolio, does that still carry water in this market? And if not, what do you think is better?
So it's a really interesting time to talk about this, because I would say there's definitely a bit of a raging debate happening at the moment with what happened last year. What happened to a 60-40 portfolio last year is it failed. And there's rhetoric on one side saying, the 60-40 is dead. And then there's another rhetoric on the other side saying, long live the 60-40. And I think, it's a bit more nuanced than that. But I think there are measures that investors can take to improve upon a 60-40 portfolio. And I can go into some of those. But I do think investors today do face a dilemma. If you're in a rudimentary, just call it a low cost index 60-40, I think you either need to diversify into alternative asset classes, or you need to moderate your own return expectations quite dramatically compared to history. So let me unpack that a little bit more if I can. So the world is, a very uncertain place, especially at the moment. There are so many seemingly kind of independent things happening that's causing a great deal of uncertainty. It's been talked about. I subscribe to the FT back home, but online, and they talk about this moment being the poly crisis. The world is in a poly crisis, right? And I think maybe there's at least lots of problems. So we'll call it many problems. And if we kind of run through that list, I think geopolitical tensions are higher than they have been probably, Ryan, in our lifetimes. Certainly what we remember, probably since the Berlin Wall came down.
Yeah, Cold War, all that stuff, the Reagan times. Yeah, other than that, it's never been this hot.
Exactly. So you've got geopolitical tensions that are very high. You've got the war happening in Europe, in the Ukraine, which is the biggest conflict in Europe since the Second World War. You've got a brewing energy crisis that's still looming, and I think Europe got a lot of luck, which is a good thing, by the way, that they had a really seasonably warm winter. But there is this energy crisis, and now this desire for energy independence, really, across the world. So you've got that backdraft of deglobalization. Deglobalization. You have structural labor shortages across the world. We've definitely got them in the US. We still have them in the US, a ridiculously tight labor market. And I'm sure a lot of your listeners see that, whether it's in still going to restaurants or home renovations or ordering stuff, there's shortages everywhere. And then at the same time, you've got a desire for supply chain resilience. So you've got a theme of kind of re-onshoring or nearshoring happening. And if you think about that, the world that we grew up in, capitalism was driven by economic incentive trumping everything else. And generally that's, not a bad system. It creates good incentives and lots of innovation. But what we found about that kind of was shattered by COVID and the pandemic, in that this just-in-time sort of way of running the world, there wasn't enough, margin of safety. And so I think there's a lot of self-reflection going on, and lots of companies focused on, how can we, re-onshore. You have the energy transition. I talked about energy security, but the world has committed more or less, but to net zero by 2050. And so we're going to have to wean ourselves off carbon fuels and fossil fuels as a way of, fueling our way of life. And we're not going to pull back on that and sacrifice our lifestyle. Like, people never do that. We're going to have to figure out with new technology how to replace that. So that's all. I could sum everything I just set up with. That's all inflationary, and it's structurally inflationary. And then I'd say the other kind of more recent wall of worries, which I'm sure we'll talk about in a bit, is there's a bit of a banking crisis happening at the moment.
I heard something about that. Yeah.
It's a bit of a throwback to 2008, but we can talk about it. So look, there's a lot, I don't want to scare listeners, and because there's an old adage, and I'm sure you've heard this, that equities climb a wall of worry or climb a wall of uncertainty. But what I will say at the moment is that wall is really, really high. And so we have to think about navigating all of that. And we have to think about what that means for a 60-40 portfolio. So after the financial crisis, a 60-40 portfolio did amazingly well. Right? A 60-40 portfolio in the 2010s returned 10% a year with not much volatility or drawdown. And bonds and equities were not correlated. They were negatively correlated. The non-mathematical way of thinking about that is one zigged and the other zagged, which is what you want. And inflation was at 2%. So you had real returns, like the keep home after the cost of inflation of 8% a year. Like, think about that as a return, like 8% a year for a decade for a really rudimentary and simplistic investment portfolio. That was a bit of an outlier. But I think what's happened is that's been baked in now to what people expect. But we're in a very different environment. And so if you look at the 2020 so far, a 60-40 portfolio has delivered about 6.5%, but inflation's been running at near 5%. So investors have been left with a much smaller slither of that return after paying for the cost of inflation. And we're almost 3.5 years into this decade already. So it's not like this is 3 months in or something. So we think that the environment is going to be much tougher. You're going to have to work harder to generate returns. So you're going to have to be more creative to generate returns. But we do think there are opportunities to generate returns. And, I think one of the forgotten asset classes, it's quite a hated asset class, is commodities. And that's one that we actually have a pretty strong positive view on at the moment. And, we think there's ways that you can thoughtfully diversify, give investors a smoother ride without paying through the roof for fees, and just generate kind of better outcomes.
Wow, phenomenal breakdown, man. So the 60-40 kind of worked. I mean, there's barely enough meat on the bone, as I like to say right now. I mean, 1.5% that you get to keep after accounting for inflation. There's barely a heartbeat there. So I can see why people are looking for alternatives to the traditional 60-40 split on allocating assets. So thank you for that breakdown. Now, you mentioned before that there's inflation, there's like a little heated geopolitical risk. I mean, there are some systemic risks in not only the North American economy, but also the global economy, I would say. And so, like with systemic risks like banking, we got banking issues, we've got inflation issues, and many others. What advice can you give to investors as far as managing these systemic risks?
Okay, so at the moment, there's a saying. It's a bit of a graphic saying about the Fed, that the Fed keeps slamming on the brakes until something goes through the windshield. All right, and it always happens, and we always talk ourselves into no, it's going to be a soft landing, and like nothing's going to happen, and it's all going to be fine. But something always goes through the windshield, and what we've seen at the moment is regional banks have been flying through the windshield in the US, and then a giant, systematically important bank called Credit Suisse then came dramatically flying through the windshield as well. So there's a lot going on. So I'll kind of unpack this a little bit. So from an inflation perspective, you've obviously, we talked about some of the structural drivers for inflation. None of those are going to be solved by monetary policy. If you go through that list, the high interest rates was not the solution to really any of them. Maybe structural labor shortages, you could say, cause a recession, make some people unemployed. It doesn't really solve the underlying problem. And I think, one of the most challenging things at the moment is the toolkit needed to solve. There seems to be kind of a mismatch between the tools needed to solve the problems at hand. But the central banks, the Fed, are going to do the best that they possibly can. And so the answer to that was rapid normalization of interest rates and the cost of money coming out of COVID. We had this fiscal stimulus, this really weird, couple of year period that hopefully we never have to go through again. Some people have been very critical of, what happened, the amount of fiscal stimulus, but generally, like, the playbook is always set up for the previous problem. And I think coming out of 2008, what policymakers learned was you need to go hard and you need to go fast and you need to go big. And that's what they did in COVID, but they went a little bit too hard, a little bit too fast, and a little bit too big, which is causing some of the problems that we're in now. So the Fed played catch up. They slammed on the brakes. We had 4 75 basis point hikes in a row, and now we're kind of dealing with the consequences. So what do you do with all of that? And how do you kind of navigate systemic risk? I think I've seen a few now, and I'd say it's a little bit like I don't know what the show was called, but I think it was maybe called Storm Chasers. Where there's like a tornado coming and they jump in that car and they like drive straight to the eye of the storm. Do you know what I'm talking about?
One called Twister, I think it was from the 90s.
Yeah, exactly. So you've got to be a bit of a storm chaser, and you've got to run to the eye of the storm and measure kind of what's happening in the thick of the moment. And so I'll do a quick sort of summary of some of the crises that I've seen and illustrate that. So in the financial crisis in 2008, it was all of the action was happening in the investment bank CDS market. And that's where you needed to kind of focus to kind of see what was going on and the acuteness of the problem. In the Eurozone crisis in the 2011, 12, 13 period, it was kind of Greek CDS and Italian spreads versus German spreads. And then, there was other things going through the COVID crisis that we looked at. So where are we today with the current systematic crisis in banking? You have to look at things that you don't normally look at on a day-to-day basis. And so we created a banking crisis dashboard that at Harbour, and we made it available to all of our clients because we wanted to share with them, on a real-time basis what we're looking at. And actually, if your listeners want to get a copy of this, if you send an email to bankingcrisisreport@harbourcapital.com, maybe we can, in the blurb, we can put the link. And so you need to look at, funding spreads, swap spreads. You need to look at what's happening in certain areas of the CDS market. And then you need to look at what's happening at the central banks and how much is being sort of drawn down on their emergency programs. And you can aggregate all of that, and then you can what's called Z-score it and look at how it scores compared to like history. And then you look at that thing every single day as an indicator of stress. And so that's what we do to help us navigate. What I'd also say is there's a psychological element to these crises as well. And I think there's really like 3 phases that we go through. Like phase number 1, I'd call utter confusion. And that's at the beginning when something happens and you literally sat around going like, oh my God, what's going on? This makes no sense. How did this happen? Like, this is illogical. And it's kind of like this complete state of denial. So we'll call that phase like utter confusion. And in utter confusion stage, you get tons of volatility because there's no anchor for setting risk. And you get a lot of questions from clients. And there's just lots of questions and there's not really many answers. And you don't really have any policy response. You then transition into kind of this complete acceptance of like, oh my, it's going to be like this forever. Like the world's never going to get back to normal. And, I remember this during COVID, like it was impossible to kind of think, how's the world going to kind of like normalize? So you have this, you quickly then flip to, it's going to be like this forever and it's going to be terrible forever. And sentiment gets really, really negative. And during this phase, you get a really strong policy response from policymakers, whether it's fiscal, whether it's monetary, whether it's regulatory, combination of all of them. And then you get what always surprises me when it happens is you get this kind of rapid normalization of the new normal, where suddenly things that you were saying a few weeks ago, they're still there, but you just now live with them and they quickly kind of fade into the background. And so I love just thinking about the psychology of this and what's happened in this banking crisis. We've gone from 1 to 2 to 3 in like 2 weeks. And the crisis hasn't gone away. The banking markets are still stressed. And if you look at some of these banks, they're on life support. And if you look at, there's something called the H41 report and the H8 report that come out from the Fed that tell you how much the Fed discount window is being used or how much I've got it written on my whiteboard, the BTFP program, which was the the bank term funding program. And these things are at really stressed levels. But, the first week they come out, oh my God, did you see the discount window? It was $160 billion. Oh, that is worse than it was in 2008. The world is ending. Oh my goodness. Week 3, you're like, did you see the bank funding? Well, yeah, it was 160 billion. Yeah, okay, all right. Right. Anyway, what's for breakfast? And so it's just it's a weird. Each one's kind of unique, but these behaviors. So I think in summary, stay on top of the moment of the day, but also be aware of kind of psychology and how quickly it can change, and measure the right things, and that's what we're doing at the moment.
Man, that what a phenomenal breakdown from one of the most brilliant minds in finance today. So thank you for sharing that. So we talked about asset allocation. Does the 60-40 still hold water? Like you just said, you're in this belief that the world's never going to change, it's never going to normalize. We got to do everything different. Well, maybe that's true. Then we talked about systemic risk. Now, I'm wondering, now, given that inflation, some people say it's transitory, some people say it's here to stay, or maybe there's a lost decade, whatever that might be. I'm just wondering, do you have have you guys created any products for you? Because you guys are very client focused. You take care of your clients. You crank out products. Have you done anything to address some of the current markets today? And if you had, maybe you can share a little bit with us today.
Yeah, so maybe if I'll give a case study and to try and sort of demonstrate how we work. And I think, but I guess it's up to your listeners to decide how thoughtful we can be. We do try and be thoughtful. And so I'll go back a couple of years ago that we had a view that this decade was going to be pretty different. And that one of the biggest kind of implications was going to be inflation was going to be higher and probably more volatile. And the zig and the zag benefit of a 60-40 portfolio is going to be less than it has been historically. And we needed something for our clients and for our own sort of portfolios as well that we run for clients to help navigate and weather that environment. And so we started off with a view, and then we started on looking at research of, okay, if we've got this view, how do you capture that view? What's the best way of doing it? And so we looked at different asset classes, and there's lots, one of the good things about finance is there's tons of data, and some of it goes back. I think the longest graph I've ever seen in finance was about 450 years old, which was the interest rates at the Bank of England, apparently. And I was like, wow, okay, that is getting kind of medieval. But anyway, you can generally go back decades, if not to 100 years. So we looked at how different things and different asset classes perform. And, if you're looking at hedging inflation or putting something in your portfolio that's going to give you more ballast in more choppy seas, you can look at things like TIPS. The hints in the name, Treasury inflation protected securities. You can look at sort of commodity-oriented equities like energy stocks, infrastructure. You could potentially look at real estate. Generally real estate. Rents rise with inflation as well. And there's some hedge fund, alternative strategies as well. Managed futures, or trend as it's called, has been quite a good one. Or you could look at commodities. So we did all of the work to see which one gives you the most predictable correlation or protection with inflation. And we from our research, we found it was commodities. And just running through the other ones, TIPS, they do protect inflation, but they're also susceptible to rises in real interest rate. And so, what happens is, the bits that readjust, like the coupon and the notional to inflation, you can lose the benefit of that if real interest rates kind of go up even faster, which is what happened last year. So TIPS didn't make any money last year. They lost money, but they lost less than nominal bonds. So not great. And when we looked at equities, sometimes they were good and sometimes they weren't. And sort of what happens is, you need to know for the underlying companies you're investing in, what's their hedging policy for underlying commodities. Generally speaking, if you've got, say, a company that wants to build a new, copper mine or an oil well, to get finance to invest in that project from a bank or the issuance of a bond, they have to hedge out the future volatility associated with that commodity price in case it collapses. They want to make sure they've got the cash flow to cover the interest rate. So generally, they can hedge out quite a lot of the underlying, especially in those initial years, the underlying benefit that you as an investor might think you might get from investing in the equities. So you have to be more selective. So it's less predictable. Real estate, we found there wasn't much of a correlation. And then with managed futures, they're pretty good. They're not too bad, but they're not as good as commodities. So then we come through and we're like, okay, we want to do something in commodities. And then we start looking at ways that we can access commodities. And the types of options available to investors, to everyday investors, like in a mutual fund or an ETF, they just weren't very good. And there's an index that is kind of like the S&P 500 of commodities. It's called BCOM, stands for the Bloomberg Commodities Index, or it's shortened for the Bloomberg's Commodities Index, I should say. So BCOM. And it's very volatile, and it suffers from kind of boom and bust. And so it gives clients not a very smooth ride, and it tends to underperform over the long term as well against a sort of a 60-40 portfolio. But actually, when you look at commodities as an asset class, I think about what they are. We summarize it with a word, but actually you've got, food, you've got fuel, you've got precious metals, you've got industrial metals, and they all behave like very, very, and then within those, you've got different underlying commodities with different characteristics, and they actually perform very differently from one another. And so there's a lot of diversification, I'd say untapped diversification that exists within commodities. And so we set about trying to figure out how could we find some expertise outside a harbour that could help crack this problem. And we found a group called Quantix in Greenwich, and they're former Goldman Sachs commodities traders. So they're founded by a guy called Don Castoro, who used to head up their commodities trading at Goldman. Goldman are one of the biggest, if not the biggest, commodities traders in the world. And so there's a real kind of domain expertise that they know their stuff. And we're able to design with them an index that is a dynamic index that allocates to differing weights of commodities at different points in the market cycle, depending on what the outlook for inflation is. So it results in a very different outcome from like the kind of standard vanilla off the shelf commodity solutions. I'll give an example of how that can work. At the moment, we've got a position of about just under 40% in gold as part of that allocation. And if you look at more standardized approaches, they're very little. I wouldn't recommend to anybody that you try and like time gold yourself. Like, it takes expertise, but gold can be a really, really good inflation hedge, or it can be a really, really bad inflation hedge. It depends on what's driving inflation. And if you look at what's happening at the moment, that wall of worry I talked about, all of that uncertainty I talked about, gold does very well against a backdrop of just general systemic uncertainty. You've got record central banks buying gold. I think a lot of central banks were shaken up by what happened last year with the sanctions around Russia. And it's been a bit of a challenge to the dollar-based system. And so last year, there was a record amount of gold bought by central banks. And oddly enough, Turkey bought more gold than anybody else. Like, who would have thunk it? But it's happening everywhere. And then you've got things like, the shock in real interest rates and things like that. So you've got all these things that, like, we think gold's going to do well now. And that's incorporated into the design of this. So we set out the problem of, what are we trying to solve for? Like, do the research, like, what's the best area of the market to aim for? And then now let's look at that area of the market. Is it any good? Conclude that it's not. And then can we improve on that with a thoughtful design? If that requires bringing outside expertise, let's bring that outside expertise. We created this index with Quantix, and now we have an ETF, the ticker's Hedger, HGER, that tracks this index. And it's been in market now for just over a year. And we're pretty pleased with how it's done. It's up 10% in an absolute sense, net of fees. And if you look at like equities are down about 10% in that time period, bonds are down about 7 or 8%. Other broad-based commodities are actually down about 2%. So they've done a bit better than the 60-40, but they've still just lost less. And it's outperformed the other commodities ETFs. And look, we work in a competitive industry. It's nice, like, what was it, Hannibal Smith from the A-Team? I love it when a plan comes together. Like, though I'm showing my age there. There's just a nice sort of satisfaction that you get when you spend so long building something and it kind of pans out.
Man, so everything's down roughly 10%. You're up 10%. I mean,
for that one, exactly.
For that particular one, apples to apples comparison, to say, well, if you wanted to just go general, the classic passive manager, or this ETF that you've done, HGER, is that right?
Yeah, that's right. HGER, which stands for hedger, exactly. And it's it's a good obviously this isn't investment advice. This is a demonstration of how we try and creatively work and use our position in the world to work with these different investors, these different boutiques with different expertise, where we can hopefully solve a real world kind of problem that helps everyday investors.
Right on. So, in this section, I call it scale it and nail it. So you've talked about how you've scaled it. Now, a final question or comments. In your opinion, in your market, who's nailing it? Is there any starlight that you're really impressed? It could be your own product or someone else out there. Who's nailing it in your opinion?
Well, I'll start by saying, like, I'm incredibly grateful for all of my colleagues at Harbour, and I want to give you all a shout out. You do amazing work. Everybody is working so hard, and I'm proud of everybody at Harbour. But I want to be impartial, and I'll give a shout out to some of the entrepreneurs out there, because being an entrepreneur can be tough. It can be lonely at times. And there's two people not related to Harbour, me, just professional contacts. There's a guy called Andrew Beer and another guy called Bob Elliott. Now, Andrew Beer runs the Dynamic Beta Managed Futures ETF. The ticker is DBMF. It's sold off a bit recently, so again, not financial advice, but like generally, what I like about Andrew is he's very mission driven. And his mission is about providing managed futures exposure to retail investors at a price point that is representing value, and without paying through the nose like kind of 2 and 20 type fees. And he's gone about it in his own way, and he's very passionate, and he's a great guy. And then the second one, Bob Elliott, is doing something similar. And Bob was the former deputy CIO of Bridgewater, one of the best hedge fund brands in the business. And he's trying to disrupt his old industry, which I think is pretty funny. And he's launched something, the ticker's HFND, which kind of stands for hedge fund for short. Yeah. And he's just up and running. He's a cool entrepreneur, and he's really good to follow on Twitter as well. And he's trying to disrupt the fees in the alternatives industry. And I just think that's sort of the irony of doing that, having coming out of Bridgewater. But they're both very creative and entrepreneurs in the space that are worth a shout out.
Man, brilliant. So you've talked about how you've scaled it. Those two gentlemen have nailed it. So we'll be sure to send them the show, and as you give them love. So, and yeah, and to the love of Harbour Capital, I also share that sentiment. I mean, it's a wonderful firm, and you and I don't have to say it, but finance, believe it or not, is a little more than spreadsheets, as we like to call it, or at least I do jokingly say we're the freak in the sheets with spreadsheets. But with that horrible joke, we'll just as we wrap things up on all that wonderful, wonderful knowledge that Kristof has shared, is just be mindful of how the market is changing, and be ready to respond more than you're ready to react. In fact, I would argue reaction isn't really a function of being ready at all. And so being ready to respond through your asset allocations. Focus on asset allocations to not only manage the downside, but also the upside profitability as things change. So learn to respond to changing markets. The second thing is pay attention to systemic risks. They exist and they matter. So be aware of those systemic risks, whether you're in public or private equities and investing. These things matter and they do move the needle. Kristof gave us a wonderful dialogue on what they are and what they've been doing to manage those. And finally, don't be afraid to create new products. Try your market, and you just might find something that your market loves. You do these things, and you too will be well on your way in your pursuit of making billions.